With interest rates near all-time lows, the role of fixed income is certainly a question that is top of mind for many investors today. And we believe that even as global central banks, including the Bank of Canada, anchor policy rates near zero, that fixed income remains a critical part of any investor's portfolio, whether it's to help diversify against equities, to pursue income, or to put your cash to work. For example, a core allocation to higher quality fixed income can add stability to an investor's equity allocation, providing ballast during periods of market stress. And for investors who are looking to generate a certain level of income and exposure to credit such as investment-grade corporates, high yield, or emerging market debt can help achieve that objective. And lastly, in today's low yield environment, many investors are looking for alternatives to cash or cash alternatives that can help them earn a little bit more and are turning that cash into fixed income, shorter duration solutions. Since the first fixed income ETF was launched almost 2 decades ago, we've seen global industry assets cross $1 trillion in assets under management. And while that is a tremendous number, it actually represents less than 1% of global fixed income market cap. So we believe there's still a lot of opportunity for continued growth. In fact, we believe that global industry assets will double by 2024 to reach $2 trillion as different types of investors, from individual users to wealth managers to institutions, use ETFs in more and different ways. And specifically, there are really 4 drivers that we think have been driving the usage of fixed income ETFs. The first has been growing adoption by institutional investors. The second is an evolution in portfolio construction, where investors are moving beyond the traditional active versus passive debate and utilizing ETFs as transparent building blocks in their portfolio construction process. And the third driver has been a modernization of the bond market more generally. And the last driver is constant ETF innovation, specifically in important areas like ESG solutions. We see clients really turning to fixed income to solve 2 key challenges in their overall portfolio. The first is a need for diversification through an allocation to higher quality bonds. And the second is a need for income as interest rates remain at or near all-time lows. On the first theme of equity diversification, despite how low global central banks are keeping policy rates, we still believe that an allocation to higher quality fixed income, such as longer duration government bonds, can be an effective ballast during periods of market stress. With uncertainties around COVID-19 and lingering impact on the global economy continue to support bond prices, at the same time, as we've seen, stock market volatility remains quite elevated. And this really underscores the need for investors to maintain that allocation to higher quality bonds in their portfolio. Broad market exposures like the iShares Core Canadian Universe Bond Index ETF, XBB, offers negative correlation to stock markets, which can help reduce overall risk in a portfolio. At the same time, on the second theme of seeking income, with interest rates at all-time lows, investors are really looking for different ways that can help achieve their income objective, particularly as cash or money market funds offer minimal amounts of interest that barely keep up with inflation. So an allocation to credit, such as investment-grade corporates or high-yield bonds, can be an attractive source of income. And we believe these sectors today are supported by decent valuations, improving liquidity dynamics, and a relatively positive technical backdrop. We find that different types of investors use ETFs for different purposes, but the overarching theme for all investors is that fixed income ETFs provide simple, transparent, and efficient ways for them to construct diversified bond portfolios. For instance, for individual savers, ETFs can be a good way for them to help generate income. For asset managers, including BlackRock, portfolio managers utilize index tracking ETFs as part of their investment toolkit. And for asset owners like pension plans, they rely on ETFs for greater liquidity, lower costs to implement their more complex LDI strategies. More broadly, I would say during periods of market stress, like we saw during the first quarter of 2020, investors increasingly turn to fixed income ETFs as a way for them to manage risk, to allocate capital, or to adjust positioning. And during that, really unprecedented period of market volatility, fixed income ETFs held up and performed as expected, providing investors greater price transparency, access to liquidity, and immediacy to trading when they needed it the most.